Hey everyone, George here. If you're new to the channel, welcome. We're very happy to have you on board. We talk all things accounting for contractors here. And today what I want to discuss is a tax strategy that if you're a profitable S-Corp, partnership, or multi-member LLC, especially if you're in a high tax state, you're not going to want to miss out on this one. It's something that I recommend to all my contractor clients that are profitable. If you're one of these, it's definitely going to result in tens of thousands of tax savings for you. But you have to do everything right so that you don't miss the boat. So without further ado, let's get started. So back in 2018, with the Tax Cuts and Jobs Act, there was a $10,000 limit placed on the state and local tax deduction that you could take on your personal return. Now with the OBBBA, they've raised that limit to $40,000. But still, if you make roughly $400,000 of taxable income or more, that still will cap the amount of tax deduction that you're able to take with respect to the state tax that you pay. So how do you get around that? There's something called the pass-through entity tax. So the pass-through entity tax, or the PTET, is a tax that your S-Corp or your partnership or multi-member LLC will pay at the entity level and give you a credit for at the individual level. And that payment that they make is allowed to be deductible for federal purposes. So this can result in a pretty good deduction, and every state has their form and variation of this. And I'm going to speak to California since almost all my clients are in California. In California, you get a 9.3% deduction for taxes that you pay at the state level. So instead of losing the deduction, it moves it upstream to the business. The business gets the deduction and passes it on to you. And obviously you get a credit for what you paid to California, via the K-1 to your California return. So again, this was very beneficial when the SALT deduction was, the state and local deduction was $10,000. Now that they moved it up to $40,000, that helps a lot of people, in the lower brackets. However, if your business makes, $430,000 or more of taxable income, it's still beneficial to make the PTET election. Now, what entity types qualify to elect PTET? PTET works for S-Corps, multi-member LLCs, and partnerships. The entities that don't qualify are sole proprietorships, single member LLCs, and C corporations. So in California, how exactly does the election work? And this is a little bit tricky. If you miss the election early on in the year, you'll miss the whole boat. Step one, you have to make the initial election payment on time. So for example, to elect PTET for the 2025 year, there's two payments that you need to make. One by June 15 of 2025 for the 2025 year election, and one by March 15 of the following year. And what are the amounts of those payments? For the June 15 election, it's a minimum of $1,000 or 50% of the prior year PTET payments made. And by March 15, it's basically the remainder of what is owed for that prior tax year. So for example, if this was my first year of election for 2025, I would need to pay in $1,000 by June 15, 2025, and the remaining tax liability by March 15 of 2026. In this case, it would be March 16 of 2026 since that's a Monday. So again, by June 15, you need to pay in at least $1,000 or 50% of the prior year PTET payment, whichever is greater. And by March 15 of the following year, you need to pay the final bill. The tricky thing is if you miss that June payment, you're out. Like, you can't make the election for that year. There's absolutely no exceptions or workarounds around that. If you miss that, you miss the boat. Now, when filing time comes around, you basically have to make an actual election for PTET on your California return and attach it with your filing. And that's something your CPA or your tax preparer will take care of for you. And it's annual. You have to renew it each year. It's not like you make the election once and it's permanent. It carries forward. So every year you need to make this election. You need to make that June payment, and you need to make that final payment by March 15 of the following year, and you need to make that election on your tax return. When you file your California personal return, your 540 return, the credit of the PTET would be claimed there on your 540 return. Now let's walk through like one scenario real quick, and I'm gonna put it down here. So for example, if we had ABC Construction Company and they had pass-through income of $800,000, and California taxes, again, the PTET is 9.3%. So that would be $74,400 that entity would pay to California. So the S-Corp, so with the PTET, the S-Corp pays that $74,000 to California. The business deducts the $74,000 on its federal return, and that's a combined 35% federal rate, deduction. So that's $26,000 of federal tax savings there. And then the owner gets that $74,000 credit on their California return. So this was especially nice before the OBBBA, when there was the $10,000 cap for the state tax deduction on the personal return, because that, in essence, that would have given you an additional $64,000 of deduction. However, now with OBBB, just so you're informed, there's a $40,000 cap, but this still, in this scenario, would give you an additional $34,000 deduction. So it is definitely beneficial to have. Even with the OBBB, that's still another $12,000 of tax savings, like if you elect it for 2025 or had elected it. So what are the common mistakes and pitfalls I've seen with the PTET election? So number one, missing the June 15 payment. That's kind of the biggest one. If you miss the June 15 payment, unfortunately, you just missed it for the year. Number two, not having enough cash in the S-Corp. So, it does need to be paid from the S-Corp is the thing, or partnership, or multi-member LLC. It needs to be paid directly from the entity. So one way or another, even if all your cash is at the personal level, you need to infuse that cash back into the business and pay through there. And mistake number three, not taking into account having multiple partners or members in your LLC. So to make the PTET election with partners or different LLC members, everyone must participate equally. Issue number four, mistake number four I've seen is electing PTET in loss years. So if you're having a loss or your entity is running in a loss, it's not going to benefit you at all to elect PTET for that year. So it's kind of pointless in that case. And number five issue I see is people thinking it's for big corporations. It's really not. Like, again, as I mentioned, if you have more than $430,000 of taxable income, it will benefit you. And as a matter of fact, it could benefit you even if you have less than that taxable income, because if you paid $40,000 in other things, for example, property taxes, other state taxes paid, through your spouse's paycheck or Social Security or what have you, this is going to give an extra layer of deduction, extra benefit. So it's not just for large companies; it's for anybody who has a pass-through entity and wants to that is profitable and wants to save a decent amount on federal income tax. So that's it. That's our segment for today. So again, the TLDR on this is if you're a contractor with a profitable business. This is a tax strategy. The PTET is a tax strategy that you're going to want to have in your arsenal of other tax strategies to bring down that taxable income so you're paying little or no tax. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.